So this is about money and the future of money. So in this lecture, I'm gonna cover a lot of history and also economics and also the future. And in preparing for another lecture, which I will give in May, which will deal primarily with the future of money. So that's in Texas to a private group. Anyway, I see that there's the way I think of it, there's three economic systems. There's the socialist, fascist, and libertarian. I represent those groups by Karl Marx would be represent the socialist. John Maynard Keynes would represent the fascist, and Ludwig von Mises of the Austrian school would represent the libertarian from an economic point of view. So our financial system, I think, is a mixture of socialism and fascism. Socialism is where you have a monopoly and ownership of the means of production, and that's by the government, and that's what we have with money. That only the government can produce money. And fascism is where there's regulation. There's private ownership, but the government is regulating everything. And that's what we've gotten in the financial industry. So Ludwig von Mises was an Austrian Jew who fled Austria in the 1930s because of the Nazis. Another Austrian economist named Friedrich Hayek moved from Austria to the London School of Economics in the 1930s in order to fight the economics of John Maynard Keynes, Keynesianism. Currently, the center of Austrian economics is at the Mises Institute in the United States, not in Austria. Money's been defined as a medium of exchange, as a means of storing value, and as a standard for measuring market value. These definitions are not always equivalent. For example, some countries have had a gold bullion standard, gold in bars or ingots, while the medium of exchange was silver coins and paper currency, valued in relation to gold. As far as measuring market value, standard for measuring market value, that's pricing, and prices are very important for a free economy. If a farmer is choosing a crop, he might see that there are shortages of tomatoes and cucumbers, and there's a glut of celery and carrots on the market. And so that would mean because there's a shortage of tomatoes and cucumbers, the prices are high. And because there's a glut of celery and carrots, the prices are low. So the farmer would compare the costs of producing tomatoes and cucumbers with the expected profits based on current and expected prices. So when demand is high and supply is low, prices will rise, creating an incentive for production to increase supply. So we have a free market in vegetable farming, but not in the production of money. The first claim to fame for Ludwig von Mises as an economist was his essay explaining why there's no rational way to determine prices in a socialist economy, because they don't have supply and demand and a free pricing system. Central planners often use clues from the market economies, to figure out how to price things. Money as a medium of exchange solves the problem of coincident wants that would exist in just bartering goods without the use of money. For example, a gravestone maker who wants to buy eggs doesn't need to find a poultry farmer who wants to buy a gravestone. Even if such a poultry farmer could be found, the gravestone maker would probably prefer to purchase eggs in small quantities on a regular basis for the rest of her life. It's far more convenient for her to trade gravestones for a medium of exchange and then use the medium of exchange to buy the eggs. So a medium of exchange allows for a time interval between selling and buying. So each transaction can occur at a more convenient time and place. So the first commodities used as medium of exchange were those that were the most durable and most universally valued. The Ethiopians continued to use salt as their money long after the European traders had brought gold and silver coins into the economy. Drachma is a Greek word for handful, and originally it referred to iron nails, a handful of iron nails. But it became the name of silver coin in ancient Greece and is currently named for the Greek monetary unit. Durability, divisibility, malleability, portability, recognizability, availability, and suitable weight to value ratio are important qualities which make metals useful as money. The ornamental value of gold and silver is derived from the same physical properties of metals which make them well suited for monetary use. The metals most resistant to being tarnished by oxidation are gold, platinum, mercury, and silver in that order, making these four the most durable of all metals. Platinum was rare in ancient times, and liquid mercury was unsuitable for coins. Minted coins are an attempt to standardize and authenticate money in portable form. In ancient times, there were private persons minting coins, but governments quickly prohibited this practice and sought to monopolize control of money and money making. Legal tender laws. Only government money could be used, require that only government money can be used as a medium of exchange. Fiat money means money derived from a government law. Literally, fiat is Latin for it shall be. In other words, something is declared to be money because the government says it's money. So governments learned early that inflation can be a tactic for expropriating wealth. It's less likely to infuriate the masses, and it's easier to administer than direct taxation. Inflation or deflation describe a relationship between the total supply of money and the total supply of goods and services in an economy. If a government has a monopoly on money creation and doubles the supply of money, the price of goods and services will double. If war destroys half the goods and services in an economy without changing the money supply, the price of goods and services will double. So in 64 AD, the Roman Emperor Nero reduced the silver content of the denarius coin by 15%. Other emperors followed his example, so that after 200 years, the denarius contained less than 1% silver, and the amount of wheat purchased by the denarius was also much less than 1% of what it had been. In 301 AD, the Roman Emperor Diocletian attempted to prevent inflation by imposing price controls enforced by a death penalty. So, moving forward to the Civil War, the Revolutionary War. Early in the Revolutionary War years, the American Continental Congress authorized paper bills, continentals, which were supposed to be worth $1 Spanish. Despite threats of severe penalty for traders who would not accept continentals, their value inflated by a factor of 75 within 4 years. When the Constitution of the United States was ratified in 1787, it prohibited state governments from issuing any form of money and only authorized Congress to coin money, gold or silver coins, but did not permit paper money. Although some question the constitutionality of the right of the federal government to issue fiat paper money, this was ignored as a result of the urgency created by the Civil War. Congress authorized the issuing of greenback notes in 1861. The choice of the color green was for the back of the bill was due to the discovery of chromium oxide green ink made counterfeiting more difficult. Greenbacks were made legal tender, meaning that the government mandated that they had to be accepted as a means of payment. Private coinage was outlawed in the United States in 1864, but otherwise, from 1836 to 1913, banking remained free under state jurisdiction, with over half of the states allowing free banking. When bank notes were issued by early reputable private bankers, they were fully backed by gold or silver. The notes functioned as debt instruments that were more easily transported and stored than bulky gold or silver. Many bankers noticed that banknotes payable on demand in gold or silver were rarely being redeemed. This allowed the bankers to lend out the gold or silver they were holding and collect interest on the loans. Lending deposit money while only keeping a fraction of the deposits in reserve is a practice known as fractional reserve banking. Fractional reserve banking is inflationary because it effectively increases the money supply. Virtually all economists support the practice of fractional reserve banking, although most Austrian economists are opposed. In 1844, Britain became the first Western nation to adopt a central bank. Britain adopted a national gold standard, with the Bank of England having a monopoly on the issuance of paper money, which was fully backed by gold. In the 1870s, virtually every country in Western Europe went onto a gold standard. A gold standard international monetary system was most complete from the mid-1990s until 1914. This was a period of intense economic activity and international trade. In 1907, there was a financial crisis in the U.S. that led to bank runs and bank failures associated with fractional reserve banking by bankers who loaned too much of their reserves. When a large percentage of depositors attempted to withdraw their funds during the run of the bank, banks were often unable to comply and had to close their doors. In 1913, with strong backing from the Rockefeller and Morgan banking interests, the Federal Reserve Act brought a central banking system to the United States, the Federal Reserve System. The big bankers wanted the central bank to support fractional reserve banking and serve as a lender of last resort. If there was a run on the banks, the central bank could just print more money and satisfy the demand. So I'm going to interrupt the history lesson and talk a little bit about the Federal Reserve System, or what's affectionately known as just the Fed, which prints our banknotes. So the Fed controls the money supply not so much by the amount of money it prints, but by the amount of reserves created in the banking system, and the fractional reserve requirement dictated by the Fed. Fractional reserve meaning how much banks have to hold that they can't lend of their deposits. For example, the Fed could increase money supply by buying $1 billion of U.S. government bonds. The Fed writes a check to a bond dealer for $1 billion from the Federal Reserve Bank of New York. And then the bond dealer deposits the check from the Fed with a commercial bank. But the check from the Fed does not clear the way other checks do. The check creates a deposit at the Federal Reserve Bank, increasing the commercial bank's reserve by $1 billion. The Fed has spent no money and did not print any new money. So when we talk about the Fed printing new money, they're not really printing money, they're just creating money by this device I just described, by increasing reserves of banks. So the Fed has created new money by simply writing a check for $1 billion. But with fractional reserve policy, which is currently 10%, the commercial bank is now able to make $9 billion in new loans. So the bank has $1 billion, so they can, but they only need to keep they only need to keep 90% of, or they only need to keep 10% of that, and they can loan out the rest. And if they're loaning out that money, and the money that's being loaned out is going into other banks, and the other banks are loaning out the money, it has an inflationary effect. The person that, so anyway, by the Fed buying the Treasury bills, the Fed has increased the money supply in the economy. It's helped support, and it's at the same time helped support the market price of the government's bonds. And increasing the money supply also is a way of lowering interest rates. And that's historically been the key way the Fed presumes to control the economy. With money, it's supply and demand. The Fed expands the money supply, prints new money, so to speak, creates new money. Then there's the supply of money is increased, so that makes interest rates go down, because interest rates are the price of money, effectively. So the lower interest rates is viewed as encouraging borrowing and stimulating the economy by Keynesians, anyway, not by Austrian economists. So in a free economy, interest rates are the price of money. Price fixing of interest rates by central banks is the same kind of central planning that was tried and failed in the Soviet Union. Mainstream economists learned long ago that price fixing of food products does not work. But they've not learned that lesson for interest rates. They figure that the authorities and the government have to fix interest rates in order for the economy to work properly, instead of letting the market set the interest rates. Higher interest rates encourage saving rather than spending. Austrian economists believe saving is the key to accumulating loanable money that does not distort the economy. Lord Maynard Keynes hated savings, and Keynesian economics is against savings. And they think spending is the key to economic growth. And not just consumer spending, but government spending. And that the government should borrow money and spend it to stimulate the economy. Keynesianism dominates government economics. And Ron Paul and his son Rand Paul are probably the only politicians who understand and support Austrian economics. The Fed believes that an inflation rate of 2% per year is optimum for the American economy. If productivity of the American economy results in an annual increase of goods and services of 3%, this will allow the Fed to increase the money supply by 5% per year to achieve the 2% inflation. And the 5% is pocketed by the government and its cronies. The 5% expanded money supply, it's a covert taxation, the covert taxation of inflation, which is to say the true inflation is 5%. Anyway, a central bank was not authorized by the U.S. Constitution, but the Supreme Court held that money making and bank regulation are essential features of government. Article 1 of the Constitution only authorizes Congress to spend money, to spend government money. The Fed creates money, it prints money, so to speak, buys treasury bonds, collects interest on the bonds, and thereby provides itself with income completely independent of Congress. The Fed operates in financial secrecy. Ron Paul attempted to have the Fed audited, but without success. And the Fed's lawyers have argued against Freedom of Information Act requests on grounds that the Fed is a private institution rather than a government agency. The Federal Reserve Act of 1913 established the Federal Reserve System, headed by the Federal Reserve Board, as a central bank of the United States. Of course, this move was touted as the creation of high-minded oversight for money and banking that would rise above the petty interests of the marketplace. Government planners would have wisdom that's superior to the free market. And so our financial system is ruled by these benevolent dictators. It's a financial fascism, basically. And so I don't think, so what have we gotten from this? Has the financial system been hugely stabilized since 1913 and the establishment of the central bank? I mean, since then we've had depression, massive inflation, one economic crisis after another. And not only that, the Fed can monetize the debt, which means that they can borrow a huge amount of money, and that the government is able to borrow a huge amount of money, but the Fed can come along and increase the money supply, meaning that it just reduces the real value of the debt by the inflation caused by the Fed. So what we'd really like to see is a repeal of legal tender laws and end the government monopoly on money. So governments engage in the inflationary practices to finance their wars. Governments impose price controls during war to prevent prices from rising, which naturally leads to shortages, which is the natural consequence of demand exceeding supply. But these shortages are blamed on the war, and patriotic citizens are expected to endure them. There was deflation rather than inflation in the century before the creation of the Fed. The purchasing power of $100 in 1813 was equivalent to $50 in 1913 because of deflation. So the value of money basically doubled over that 100 years. However, the purchasing power of $100 in 1913 was equivalent to $2,300 in 2013. So we had an inflationary factor of 23 times, a multiplication or a decrease in the value of our money since 1913, the creation of the central bank. So that's what our central bank has done for us, protecting us from the free market. In New York State, which had the largest and most free banking system in the 1800s, bank failures from 1838 to 1863 were less than 1/3 of 1% per year on average, with customers receiving an average of 75 cents on the dollar in the failures. By contrast, under central banking, the rate of bank failures in the 1930s was in excess of 2% per year, and in the 1930 to 33 period, about 1/3 of all U.S. banks failed. Depositors had lost more money in the first 20 years of central banking than they lost in 75 years before central banking. So let's return to history. Only 21% of the expenses of World War I were funded by taxation, whereas the rest was financed by borrowing and money creation by the Federal Reserve System. The American money supply was doubled during World War I, but the inflation in its European allies, especially Germany, was much worse. World War I represented the end of a complete gold standard. From World War I, the amount of gold reserves held by central banks was not equal to the amount of paper money that had been issued. But the British pound sterling was still regarded as being as good as gold. The British pound sterling continued to serve as the world reserve currency. But after World War I, Britain would only allow redemption of its currency in bullion by foreign governments, not by individuals or companies. Other governments held British pounds as reserves. In the late 1920s, the British pound reserve of France was equal to 2/3 of the entire gold reserve held by the Bank of England. In 1931, Britain had to go off the gold standard, and the value of the pound dropped by 30%. Greedy speculators were blamed. In 1933, President Roosevelt issued a proclamation that everyone in the United States was compelled to exchange their gold coins, gold bullion, and gold certificates for Federal Reserve notes at the official rate of $20.67 per ounce. Non-compliance could result in severe fines and jail terms. At the end of January 1934, the price of gold was increased to $35 an ounce, a 40% devaluation of Federal Reserve dollars, and a comparable increase in the value of the government's confiscated gold holdings. The 1930s was characterized by competitive devaluations of currencies by nations of the world, which was part of the impetus for the Bretton Woods agreements at the end of World War II. World War II had left the United States with 75% of the world's gold, and the American economy had been relatively undamaged by the war. There was a conference of 44 World War II allies held in Bretton Woods, New Hampshire, in July 1944. Lord Maynard Keynes was a key architect of the agreement that was signed at that conference, the Bretton Woods Agreement. Bretton Woods established an agreement that provided for the U.S. dollar convertible to gold at $35 an ounce to be the basis of international payments. All other currencies were to have fixed exchange rates against the dollar within a 1% range, supported by loans from the International Monetary Fund, the IMF. Only the U.S. dollar was redeemable in gold. Other currencies can only be redeemed in dollars. The IMF acted as a lender of last resort for central banks trying to buy or sell the currency of their country to stabilize the currency's exchange rate. A gold market had been established in London, but the major financial powers pooled their resources to sell gold on the London market so as to keep the price at $35 an ounce. Speculators bought gold in the London gold market in anticipation of eventual revaluation. In 1971, U.S. gold stocks were half of what it had been in 1958. France was particularly determined to convert all the dollars they had into gold rather than use dollars as backing for the French franc. In August 1971, U.S. President Richard Nixon imposed wage and price controls while suspending gold convertibility so as to defend the dollar against speculators. The collapse of the Bretton Woods system left the world on a pure dollar standard, which was undermined within 2 years following 2 devaluations of the dollar. Fixed exchange rates were abandoned as most nations chose to float their currencies. In 1974, President Gerald Ford repealed sanctions against Americans owning gold, but gold could only be used as a commodity, not as money. Legalization of gold ownership for American citizens was probably less motivated by a libertarian spirit than by a desire to see the market increase the value of government gold reserves. Austrian economists generally believe that the 2008 housing financial crisis was primarily due to excessively low interest rates by the Fed. But in my opinion, the crisis was mainly due to Freddie Mac and Fannie Mae causing excessively permissive mortgage lending practices to people who could not afford the mortgages. I spoke about that in a previous meeting of this group. The government has more than one way by which to screw up an economy. In response to the housing financial crisis, the Fed and Treasury Department began massive borrowing and spending program that drove interest rates nearly to zero and caused national debt to skyrocket. After interest rates had been driven nearly to zero, the Fed pumped even more money into the economy by buying more Treasury bonds and toxic mortgages in a process known as quantitative easing. This process did not produce massive inflation, because the economy was so bad that the banks did not want to loan their new money. Additionally, the Fed began the unprecedented policy of paying banks interest on their reserves. Near zero interest rate allows massive government borrowing with low cost of borrowing. But if the economy begins to recover and interest rates begin to rise, the interest the U.S. government will have to pay on its debt will be massive. Time magazine named Fed Chairman Ben Bernanke Man of the Year for being the national hero who saved the economy by all his massive spending policies and bailout policies and printing policies. To quote from Milton Friedman, the Federal Reserve System blames all problems on external influences beyond its control and takes credit for any and all favorable occurrences. It thereby continues to promote the myth that the private economy is unstable, while its behavior continues to document the reality that government is today the major source of economic stability. Primary dealers include Wall Street investment bankers such as Goldman Sachs, J.P. Morgan, Merrill Lynch, etc. Primary dealers are financial institutions that are given the privilege of buying bonds from the Treasury Department and selling those bonds to the Fed. Thanks to the Fed, the six largest banks earned $51 billion in 2009, the year after the recent crash. In 2009, the 980 banks ranked in size below the top six lost money as a group. New regulations after 2009 have created operating expenses too great for many small banks to survive. The largest owners of U.S. government debt are the Federal Reserve System, followed by China, and after that, Japan. If the U.S. dollar ceased to be the world reserve currency, all those dollars would flood back into the United States and cause massive inflation. China and other nations of the world do not want the U.S. dollar to continue to serve as the world reserve currency, especially in light of the American Central Bank's massive money creation policies. China is accused of currency manipulation when it tries to extract itself from U.S. dollars. So now I'm going to talk a little bit about prospects for the future of money. There's a trend for credit and debit cards to replace the need to carry cash. Smart card transactions can be less costly than credit or debit cards. Plastic cards for payment are more durable, sanitary, and convenient than paper currency. Paper currency and coins may become obsolete within the next decade or two. Smartphones for electronic payment are more convenient than plastic cards, which they will probably replace plastic cards. Generation Y is noteworthy for doing all financial transactions digitally without ever writing checks or using cash. Money laundering laws have developed mainly in association with the war on drugs and attempts to combat terrorist financing. In money laundering, money obtained from illegal activity is made to have come from legal sources such as parking garages or a casino. Banks and other financial institutions are required to acquire and verify identifying information about their customers and to report any suspicious monetary transactions to the government, including any transaction over $10,000. According to The Economist magazine, anti-money laundering compliance rules have imposed onerous costs upon financial organizations without producing much benefit, such as producing terrorist attacks. Know Your Customer (KYC) laws have been implemented internationally to prevent identity theft, money laundering, and terrorist activity. The 2001 USA Patriot Act makes verified legal identity a requirement for all banks. M-Pesa is a mobile-based money transfer system based in Kenya and Tanzania. Users with a national identity card can store money on their mobile devices and transfer that money to others electronically. As of 2012, there were 17 million M-Pesa accounts in Kenya, which has a population of 44 million. National identity cards satisfy the Know Your Customer requirements. eGold was a digital gold currency company founded in 1996, which allowed digital transmission of quantities as small as 1/10,000th of a gram of gold for little or no cost. There were nearly 5 million users of eGold in 2008 when the company was shut down by the U.S. government and the directors charged with money laundering and operation of unlicensed money transition business. The Treasury Department did not want to acknowledge eGold as a form of money, which made it impossible for them to obtain a license. Liberty dollars were coins produced in the United States beginning in 1998 by a libertarian named Bernard von Nottes. The coins were promoted as being medallions that could be used in barter rather than as a form of currency. In 2007, the FBI confiscated from von Nottes 2 tons of gold, silver, and platinum coins bearing the image of Ron Paul. Von Nottes was convicted by a jury in 2011 of making coins confusingly similar to U.S. currency. The prosecutor described Liberty coins as a unique form of domestic terrorism that is trying to undermine the legitimate currency of this country. Although von Nottes faces up to 15 years in prison, his sentencing is still pending. He appeared as a mystery speaker at the North American Bitcoin Convention in Miami Beach in January. Bitcoin is a decentralized digital currency and payment network based on cryptography. Bitcoins are digital rather than physical entities, and they're represented as 34-digit alphanumeric addresses. Ownership and transfer of ownership of Bitcoins is validated by a computer network of participants insofar as there is no central authority. Bitcoins are created by validating Bitcoin transactions, a process called mining. Bitcoins are valued because other will accept them as payment, and because the computer code which creates them limits the ultimate supply to 21 million Bitcoins. A Bitcoin is currently worth about $500 US. Bitcoins can be subdivided into units as small as 100 millionth of a Bitcoin, a unit known as a Satoshi, a unit of value equal to 1/2 of 1,000th of 1 cent. Every Bitcoin transaction is confirmed by being included in a public master ledger called the blockchain. Any participant in the Bitcoin network can compete for Bitcoins by trying to add the most recent block of transactions to the blockchain. Adding a block of transactions to the blockchain requires solving a difficult math problem using a computer. The one competitor who succeeds in adding a block of transactions currently earns 12 Bitcoins, which is worth about $6,000. Blocks of transactions are created about every 10 minutes. Bitcoin was created by an anonymous libertarian computer cryptography expert who used the pseudonym Satoshi Nakamoto, which is the Japanese equivalent of the name John Smith. Satoshi was critical of fractional reserve banking, central banks, and the havoc these institutions inflict on economic growth and human well-being. Bitcoin enthusiasts are often libertarians. Adrian Wiley, the Libertarian Party candidate for governor of Florida, is a Bitcoin miner who spoke at the North American Bitcoin Conference held in Miami Beach in January. Over 200 Over 20,000 businesses and charities now accept Bitcoins, including WordPress, Overstock.com, Tiger Direct, Virgin Galactic, Tesla Motors, and Reddit.
And marijuana ATMs.
Bitcoin is usually purchased by trading fiat money such as US dollar for Bitcoins at exchanges such as Coinbase or Bitstamp. Many cities now have ATM machines which dispense Bitcoins in exchange for fiat currency. There's a street shop selling Bitcoins in Hong Kong, and localbitcoins.com can be used to arrange for in-person exchange of fiat money for Bitcoins. Bitcoins can be sent across national boundaries at little or no cost, in contrast to bank and wire service money transfers. Rational Wiki describes Bitcoin as a libertarian hobby horse of no practical value to anyone other than those trying to undermine the government. An Austrian economics conference was held at the Mises Institute in March, at which there was only one presentation about Bitcoin. The Austrian economists appear to be far too attached to a monetary gold standard as a means of preventing inflationary government practices, and some are actually hostile to Bitcoin. By contrast, there were a high proportion of Austrian economic supporters at the North American Bitcoin Convention in Miami Beach in Florida. Most members of the Fort Lauderdale Bitcoin meetup are libertarians, two of whom are attending this meeting. If you'll raise your hands. But some Austrian economists are strong supporters of Bitcoin, including Jeffrey Tucker, who lives in West Palm Beach and who spoke at the Bitcoin convention in Miami Beach. Tucker ran a cryptocurrency conference last October, and he is starting a website at the domain liberty.me, which will promote Bitcoins as an alternative to central banks and central bank money. Bitcoin transactions are taxable as barter. Americans engaged in barter are expected to determine the dollar value of their gains and report them on Form 1099-B. In February 2011, a company called Silk Road began operating as an online retailer on the encrypted Tor network, which allows for anonymous browsing and purchasing in Bitcoin. Although the site sold a wide variety of merchandise, many viewed it as being the Amazon of illegal drugs. In March 2013, Silk Road was selling 10,000 items, but 70% of the sales were estimated to be illegal drugs like heroin, cocaine, and LSD. Silk Road was shut down by the FBI in October 2013, and the FBI seized over 26,000 Bitcoins, worth about $3.6 million from user accounts. In May 2013, the National Security Agency whistleblower Edward Snowden flew to Hong Kong and revealed, among other things, that the NSA was tapping underwater cables to secretly access Yahoo and Google data centers to search email content. Snowden was able to receive donations anonymously in Bitcoins while he was a fugitive in Hong Kong. And WikiLeaks also was cut off from any access to banks, and they were also able to support themselves by Bitcoin. In June 2013, the government of California issued a cease and desist order to the Bitcoin Foundation, charging the organization with engaging in the business of money transmission without state license and without having registered with the Federal Treasury Department, which would have been a felony. Actually, the Bitcoin Foundation is a nonprofit organization dedicated to promoting Bitcoin and does not engage in a money transmission business. There is no central authority that can be attacked by the government to stop Bitcoin. In February 2014, two men were arrested in Miami for agreeing to sell $30,000 worth of Bitcoin to undercover agents. And that this was in violation of anti-laundering laws that make exchanges above $10,000 illegal without a license. In January 2014, Russia's central bank issued a statement saying that alternate currencies are against the law. The Russian exchanges, which were exchanging rubles for bitcoins and other currencies for bitcoins, had to shut down. So I'm not going to. I can only say a few things about the future of money. I don't have a crystal ball, and I haven't given as much thought to that subject for this presentation as I'm going to be giving for the future. But I will say a few things. I gave the example of Russia. There's currently only some governments that are really actively hostile to Bitcoin. Banks and governments may, but I expect banks and governments may become increasingly hostile if it threatens to replace central banks, fractional reserve banking, and the government monopoly on money. Or are threatened by the anonymous character of cryptocurrencies that can allow for tax evasion. A major confrontation of governments and their government crony banking partners against Bitcoin seems inevitable to me. I see a couple of things which I think could be a source of vulnerability for Bitcoin, and the Bitcoin experts may have their own opinions about this, but I think, unfortunately, Bitcoin mining is becoming increasingly concentrated in the hands of fewer and fewer miners. And this concentration of Bitcoin miner could represent a serious vulnerability. And I'm even wondering if the enemies of Bitcoin could try to destroy the system by bombarding the network with transactions denominated in Satoshis, 100 millions of Bitcoins. If that could swamp the blockchain, you don't think so? Would some third world countries adopt Bitcoin as parallel currency to its national currency? In the past, gold and silver bimetallism, gold and silver were both accepted as money. And could something like Bitcoin be accepted in parallel with the M-Pesa of Kenya and Tanzania? Would the use of Bitcoin thrive just the way alcohol consumption thrived during the Prohibition, even though exchanges cannot operate openly? In countries, I believe that the widespread adoption of countries could be greatest and happen first in countries like Argentina and Cyprus, which are very obnoxiously trying to control the currencies of their country, control any exchange of the currencies of their country. But these are just speculations. It is my great hope that Bitcoin will replace, will drive fiat money out of the market, out of the world. Central banks stranglehold on our economies to bring this stranglehold to an end. That is my fervent hope. If anybody wants to learn more about some of the things I talked about, I could recommend Ron Paul's book, In the Fed, which you've probably all heard about. There's another book that's good at showing how the damage that the Federal Reserve System has caused the economy by the book's called Free Prices Now. There's as far as Ludwig von Mises was the originator of the Austrian theory of business cycles, which says basically that the central banks will expand the money supply, will do all this pumping of money in the economy, and lower interest rates and cause an artificial boom, which inevitably leads to a depression or a recession. This is what actually Murray Rothbard, a more recent Austrian economist, wrote America's Great Depression, which explains how the Fed money pumping led to the stock market crash in 1929 and the Great Depression. And Ludwig von Mises was the actual originator of this Austrian theory of the trade cycle. And this book is a collection essays by Ludwig von Mises and Barry Rothbard and Frederick Hayek. And for an overall book for an introduction to libertarian economics, I highly recommend Mark Skousen's Making of Modern Economics. And I've got some other literature which you're free to examine. Are there any questions?
Yeah.